welcome to another episode of the Byproduct podcast. I'm so excited that you are joining us here today, getting better together, because when we get better, things get better. And I am joined by my friend here, Aaron Amuchestegi, absolute real estate rockstar. In fact, owns the Real Estate Rockstars podcast. And this guy is just an absolute legend in the real estate world. I mean, he's been dominating this industry in ups and downs in a lot of different ways with a lot of different ideas for 2 decades now. I mean, you've been crushing it, and you're one of the guys that I look to for sort of understanding what's going on in the markets, what's going on in the world, what's going on in finance and in business, and so you sort of have this niche out into the trend spotting, the forecasting, the data aggregation into something useful. What does all this crap mean that they're talking about in the news, and how do we position? And so you have taken these things, this ability to look at data and what's going on in the world, and you have created multiple large scale wins where you have sort of gotten to the right place at the right time before the rest of the world. Right. And so you've done this a number of times in a number of different markets with a number of different asset classes. And so I reached out to you. You were posting some of that stuff. And I'm like, bro, you got to get on the podcast. The world is a freak show right now. Right. I mean, it's bad out there. It's crazy. I mean, up is down, left is right. What's going on? What do you think is going to happen? I said, let's get on the podcast and let's talk a little bit about it. So Aaron, welcome, my friend. It's an honor to have you. And talk a little bit about sort of how you got into this trend spotting data niche that you're in right now, and sort of what your experience has been there. And then we'll dive into some of what you see going on right now and what we think we should be doing about it.
Yeah. Well, Ian, thanks for having me on. And listeners, this is going to be really fun for you guys, because like Ian and I, we don't get to catch up often enough. We met a couple years ago, and our families got to follow along with stuff. We've got a bunch of stuff in common with like businesses and books, book writing and homeschooling. We were like speaking at the same events, all sorts of stuff. And so when we get to catch up, all the listeners today, they get this behind the scenes talk of like a talk that you and I just kind of want to have with each other. Yeah. Right. Because we want to go like, hey, this is what's happening, market wise, and what have we seen? The way I got into this is it almost by accident, right? I had this like analytical mindset, but I graduated in construction management way back in 2005, which was the height of the housing boom, right? Like the height of the housing boom in Southern California. I was working for these like big home builders at the time. And so I got to go in their back office and figure out how did they analyze real estate statistics for essentially what was the absolute most they could sell their properties for in a neighborhood with other properties. So I got to learn all their ways that they would essentially value properties, and how they would like take all these lines and graphs and based on run these different matrix formulas. So we did a lot of analysis like during the peak, but the funny part back then, Ian, was like everything was selling. So the analysis worked pretty darn well. We'd be able to plug it and chart it, and it was always just better. But the funny part was it wasn't necessarily accurate because the market was so strong. Like accurate is if I said in 6 months it's going to sell for 250 and it's going to sell for 250. What was happening in 6 months, it was selling for 280. So they were like, the market was making everybody look brilliant. So we weren't really sure who was right and who was wrong.
Yeah, your dog could buy real estate in that market and put out a course about Bow Wow's $1 million real estate.
Yes, and it would have been huge, and he would have been right. The market starts to crash in 08, 09, and we started to like see, you saw like banks getting taken over by the FDIC. IndyMac getting taken down. There was this bank out of, Nevada and Phoenix. And so we got hired by a group at that time to go like analyze their book, right? Essentially, they were like, we want to buy this $1 billion portfolio from this bank that they just took over. What's it worth? And they said, we want you to do this reporting, but they kind of showed me how they wanted the reporting to look. And at this time now, I'm like 27, 28 years old. But getting to see like what these big hedge funds used for their analysis, I got to go like, oh, they wanted to see what was it worth at the peak? What is it worth at the trough? What is the replacement value? So I got to see all these different statistics that I hadn't even thought about. So then I started running Excel sheets and like, building all these things that would track that data, and started to kind of take their stuff and try to make it better. So I got to see those different markets, how it was going to be working. And then like a few of the really big wins that I had along there. So when I started to learn how to spot, there's a few things you need to do. You need to learn how to spot the trend. One, you need to know what your plan is going to be with that trend. And then you need to take action. And sometimes that action is limited by, do you have enough money? Do you have enough investors? Do you have, sometimes you can be like, hey, I know right now I need to buy 100 houses, but I don't know how to buy a house and I don't have money to do it. Right. So there was different times of that when I first started getting into 2009, right? Like our home builder that I worked for was now put out of business. We're trying to figure out what's next. We couldn't buy foreclosures from other people on MLS. We discovered courthouse step stuff. And we were like the third people buying courthouse steps in Sacramento. And I was the first one to run it like a fund to go, hey, we can do this at scale. These other guys are buying like onesie, twosie houses. What if I ran this like a home builder and really went big? One of the things that limited me then was not having quite enough funds, but I had a really good business plan and I had to raise funds to make that fund grow. And so it grew slowly. It ended up growing really big, but it was like I knew exactly the opportunity, but I was missing that money part. And 2015, we kind of, after having like this big cycle of making lots of money from 2009 and then everybody getting into the business in 2013, then I started to find these other markets. I started investing heavily out in Austin, Texas back in 2015. And, back then prices hadn't gone up in Austin for like 15 years. It was just nice and stable. In 2019, 2020 hit, like the stuff I bought in 2015, it tripled in value, man. It was like these really lucky bets. And then, and then January 2021 was probably our next biggest bet where we saw, if you remember during 2020, housing market went crazy, but January 2021, it started to like kind of slow down. People were like, oh man, prices went up. We've got to be peaking soon. We got to have a crash. It's not going to keep going. But we looked at some of the market data. We looked at essentially the new people, Biden getting elected, knowing what their monetary policy was, knowing what that monetary policy was going to do to housing. I remember texting a buddy January 2021 saying, we need to buy $40 million worth of houses in the next 90 days. Send me everything on MLS that's built after. I said, like anything built after 2000 on MLS in these counties, I'm making an offer today. And he was like, awesome. So I've seen lots of cycles. I've seen housing market where houses sell so fast. I've seen housing market crash where $700,000 houses are now 200. And I try to take that and compare today to what, how it rhymes with the past.
Yeah, no, that's really interesting. Something I love to tell people is in God we trust, and all the others must have data, right? And that's what you're doing. You're making these sort of educated guesses based on what you're seeing in these macro trends. So, talk to me right now. Like interest rates are a big thing right now. Fed just bumped them up a quarter point again yesterday, right? Okay, They're the highest they've been in 18 or 20 years now at this point. What do you see happening there in the future? What do you think is coming in the next 90 days, the next 6 months? And how do you think that's going to affect the real estate market and some of the other markets that are attached to that market?
Yeah, it's really funny. I know you probably saw the video that I put out, I remember last September, where I said the Fed's going to raise rates for another 9 months. But we're not. And I think my quote at the time was the Fed's going to raise rates for another 9 months, but we won't actually see the impact of those raises until we won't see the final trough of that for another 9 months after, because it takes time for like the damage to occur. And so far, the first part of my prediction has been exactly right. When people are saying, no, they won't, and there's all this other stuff, I'm like, no, based on what they did, back essentially in 2007, 2006, 2007, 2008, the market was on fire. They started raising rates to change the market then. And that was part of what started the crash back then, but we're not quite looking at the same sort of stuff. So what do I see now? What do I predict now? Do I think the Fed is done raising rates? There's a couple challenges that the Fed has right now. And so do I think they're done? I think they're almost done, but I don't think they're done yet. And here's part of that. Like a month ago, inflation started to come down quite a bit. They started to see like some markers of what was happening. But at the same time, that's when OPEC got together and said, let's limit our crude oil going out. Now, what is that going on? To me, there's like some political warfare going on. It's seeing like, okay, the U.S. has inflation under control. Let's see if we can boost oil prices back up, because oil prices show a lot of that stuff. So you see like the Fed is doing some things to fight inflation by raising rates, but there's other things out there that are going to like keep inflationary measures high that's going to push it. Biggest cause of inflation was all of the extra money that people saw back in 2021, during 2020, during 2021, both administrations, lots of free money, lots of PPP funds. The reality is when everybody has lots of money, we're quicker to spend it. That makes inflation go up because we're like, hey, this isn't my money. Like yeah, normally I'd only pay $1,000 for this, but it's not my money. I'll pay $1,500 for it. That's what causes inflation.
Sure.
Like the only thing that really reverses inflation, that like the other things that the government could do, or maybe kind of will have to do, is figure out how to pull that money back. Like, how do they take money away from people through taxation, through taxing wealthy people, through restricting certain businesses? And what they've been doing is they've been, to do that, they've been raising the Fed funds rate, which made it harder for, businesses to do lending. Now, it affects 30-year mortgages. So one thing in the housing market, it's made 30-year mortgages go up to like this rate I think 30-year mortgages are going to be between 6 and 7% for the next 2 years. So
Okay.
if people are waiting for rates to come down and they want to buy a house, I don't think they should do that. What it affects bigger is investors, people buying, because the Fed funds rate is directly tied to the loan I'm going to get from a bank for a line of credit to buy land and build a subdivision, to buy an apartment and build an apartment. And those are usually like these 12 and 24-month loans. A lot of developers got those about a year ago. Since then, commercial real estate prices have come way down. Development prices have come way down, and we're starting to see some defaults in that category.
What do you think that is going to occur there, right? Because that's a concern to me in the commercial lending space, right? Is you have all this short-term debt that people got at 3.5, 4, 4.5, 5, and now it's going to come due at 6, 7, 8. And at the same time, the appraisal values are going down on a lot of these properties, right? Because there's just not as much capital out there. The margins are a lot tighter. Do you see like a large scale, sort of across the board default situation happening there? And what do you think is going to occur, to people that are holding a lot of these multifamily assets right now?
Yeah. And I think this is the biggest intention that like the Fed has when they're raising these rates. Like what are they trying to do? So nobody likes a housing market crash, right? That was bad. And I don't think we're going to see housing market crash again. We've seen prices come down quite a bit, but most people have equity and can sell. They're just not quite as rich as they were. So check. Fed raised rates. Home prices are now down 25% of where they were a year ago in most places, except for sunny Florida down the street from you.
Oh my gosh, it's still crazy here. I can't believe it.
You're safe where you're at, but everywhere else in the United States, home prices have come down 20 or 25%. So if somebody had 200,000 in equity, now they've got 50,000 or 100. All right, check. There's less money in the market now. Less money people can tap into. They can't sell their house quite as fast. Cool. That's going to help inflation. On the office side of it, though, there are so many office buildings, so many huge commercial buildings that are in default right now, that are in a significant amount of default. And I do predict that we're going to have a tsunami level event in office and retail, where we're going to see foreclosure after foreclosure after foreclosure and trading, vacancies going way up in office space stuff. So I'll tell you something really quick. So a big thing that causes that is office loans are not long-term loans usually. Yeah. They are 3 to 5 years long. And then they get reset, and they are valued on cap rates. And so cap rates are when interest rates are low, cap rates are low. So if a cap rate is 5% and you make 50,000.
What is a cap rate, Aaron? Can you explain that to the audience?
Yeah, totally. So a cap rate is essentially like, what's your annual return on an investment? So if you have $1 million property and your cap rate is 5%, that means your income is going to be $50,000 a year, right? So income's $50,000 a year. It's worth $1 million because that's 5%. And so when interest rates are low, cap rates stay low. So now the interest rates are up to 7%. And really in the commercial space, they're between like 7. I just got quoted on a 7.1 ARM for like 7.75 for a commercial property.
Yeah, they can be as high as like 9, 9.5.
Yeah. So now let's say your cap rate goes to 7% on your money. So now your cap rate's 7%, but you're still only making $50,000 a year. Let's say like the property performs well. There's also vacancies. There's also these other things going wrong, but let's say it performs well and nothing happens except for interest rates went up and that changes the cap rate. Well, now to get your $50,000 a year on a 7%, that property is now worth like $770,000, right? Or I guess it's worth 700,000. So 700,000 times 7% is 49,000 a year. So that means your $1 million property at a 5 cap is only worth 700,000 at a 7 cap. So they go to refinance now. They tell Mr. Bank, it's time to refinance. I've done great. I actually have 100% occupancy. Mr. Banker says, well, your loan was 900,000. Your property's only worth 700,000 now. So that happens. So we get foreclosures, you get change in valuations. That's 30% change in asset value in commercial and office over a 12-month period just because of interest rate increases. So that And because those loans aren't long-term, people are like housing won't crash because people got 30-year fixed at 3%. That's true. Office and commercial, we don't have that. So you can see a lot of stuff trading hands. And why
Yeah.
wouldn't they? And a lot of businesses strategically let that go. Last thing on it, sorry. Most people
No,
that
that's
own
good.
these aren't Blackstones. They're pension funds, they're stock market stuff. Like they're like the teachers fund, like the police officers fund. So middle America on their investment accounts that they think are like these pension retirements that are safe, they will get hit the hardest in the commercial office space. That a lot of people don't even realize that or talk about that. You see in the news like, oh, Blackstone is in default, or Credit Suisse has this big hedge fund in default. Well, when those things start trading and going, most of them are actually owned by pension funds.
Yeah, that's very interesting. What do you think is going to happen with all of that space? So what we're seeing here in Florida, there's some big commercial mall space that they're actually repurposing, and they're going to put, it's going to become multifamily with multi-use restaurant, retail, and residential all together. What do you see happening with all of this space that, we had the online revolution that was accentuated by COVID. My dogs are fired up about that one, right? So you got a bunch of people that just don't need the space anymore. The cap rates are rising, the interest rates are rising, the values are falling. What do you think is going to happen with all of that product that's sitting out there?
Yeah, I think it depends on the city. So Austin, Texas, for example, yeah, the real estate part, there's a high demand for residential downtown. So there's these big towers that were built over the last few years for Google and Facebook that frankly now they've subleased, right? So there's way too much office space that's been built in Austin, but the stuff that's doing really well are the 40-story high rises that are multifamily on floors like 4 to 40. On the third floor, there's some office. On the second floor, there's restaurants for the people. And so that sort of mixed use, I think for big cities, that mixed use is now the ideal. I don't think there's any reason to have a high rise that's just office anymore, because it's not the best use for parking, for all sorts of different things. Yeah. So I think that in bigger cities, there's an opportunity for those sort of conversions, converting office to multifamily, although it's a big endeavor to get, plumbing and infrastructure, through those. I think that's going to be the best use for some of those. I struggle to figure out and so like what you're seeing in Florida with the mall. Yeah, you could have these really cool kind of ideas like I can see enclosed malls becoming these really cool, like lifestyle living areas that are like protected from climate, whatever. But smaller towns, middle America type office buildings, I struggle to figure out what they're going to do. The office building that I have in West Austin that I'm a tenant at, I'm the largest tenant there, but there's like 80% vacancy in that building. Wow. Wells Fargo was the main tenant on the bottom 3 floors. Well, their lease was up and they left. And so you go from having one that had a Wells Fargo and a FedEx and a UPS on the bottom floor to now it's empty and it's open. It's not big enough to repurpose into multi. So I think in bigger cities, they're going to repurpose to multi. I think it's brilliant. I think big malls could be repurposed into things like that, like strip mall type areas. Storage, I think, has now been kind of overbuilt, but storage was a big opportunity.
Yeah. So I think there is an opportunity there. I don't know what it looks like, right? But somebody who can solve that problem is going to make a lot of money, right? What do we do with all these buildings that nobody wants or needs anymore, right? Talk to me about the dollar. There's a lot of movement away from the US dollar as reserve currency. There's a lot, I'm sure you're following that, right? A lot of our trading partners are saying, hey, let's just cut out the middleman. We don't need to trade in dollars anymore. We're going to create our own consortiums and our own trading platforms. You see the Fed dollar, whatever they're calling it, the central bank digital currency push. What do you think is going to happen here? Where do you think the risks are? Where do you think the opportunities are with all of that that's going on?
Yeah. So there's a lot of problems with the US dollar getting devalued by other countries. Right. And so what does that mean? That means like our ability to trade with other countries and do business with other countries. Our dollar won't go as far. So if we're going to go buy a product from China, if they don't like the dollar as much, the discounted product isn't as discounted. So essentially, like when we're importing, stuff is going to cost more, but then internally it gets devalued. So it can help inflation in one sense internally for like US businesses, but when we're trading to outside countries, it doesn't go as far. It's going to take more dollars to buy those products, which essentially hurts our inflation even worse. So if
Sure.
China says they're coming off the dollar, that hurts our inflation, right? And there's a lot of countries like that we have our debt from. Now, I don't blame the other countries. What do I mean by that? Like, so the Russia scandal, the Russia craziness with Ukraine, right? All right. There's however you feel politically, there's this craziness. And then what happened was the US said, okay, we are going to take this Russian billionaire's money. We're going to take this Russian billionaire's account. We're going to seize this Russian billionaire's yacht. So the Russian billionaires are saying, why would I ever have anything in the US dollar if for any reason at all, they can take it? So the US has kind of weaponized the dollar. The US government has weaponized the dollar in the last few years. And so they like to take other people's funds. Well, that's going to make wealthy people a Russian billionaire used to think, man, my money isn't safe in Russia. I'll go put it in the US. We like that. Chinese guys too. Chinese people are buying houses in the US. They're like, oh, these assets are safe. I don't want to keep my money in China. I'm going to keep it in the US because they're worried about their own countries. It's showing they're less worried about their own country. So I don't blame them. That's why they're wanting to come off the dollar. I think China and Russia and those guys will come off the dollar as the reserve currency. So what does that mean? That's an extra inflation fight for us to have. Figuring out what our solution is for that. Like, what do we do next? Like, as the US is trying, because Bitcoin and gold was traditionally Bitcoin was supposed to be a really helpful offshoot to that. But we saw it kind of perform when the dollar was going down. It was also going down at the same time. So it didn't quite act inversely like we thought Bitcoin would. But I think that's because of the political pressure stuff with it.
And gold's the same way, right? I mean, gold should be $2,600 an ounce right now if it was tracking in the inverse dollar, but it's not. It's sitting at 2 and some change. It's very interesting. The more concerning thing to me, Aaron, about moving away from a reserve currency is our inability to use it as a diplomatic means of pressure anymore, right? So, sanctions and other things, when people have to trade in your currency, right, to do stuff, and you don't like what they're doing, you can restrict their access to it or other things, like you're talking about weaponizing. And that gave us a line of defense with a lot of these other countries that we're not going to have any further. We're not going to be able to shut off their, we could stop effectively trade between two different nations that were trading in our currency by putting sanctions and other things on it that now we won't be able to do. And so, my fear is that we may see a more violent world where we have to protect our interests militarily instead of economically, as we've been able to do for quite some time, pretty successfully, because of that generally worldwide accepted, U.S. dollar basis for being the reserve currency and where people trade.
Yeah.
What do you think about that? Do you think that's a reality? Do you think I don't think that's going to happen, or what do you see happening?
You're spot on, right? Like it was a weapon, and recently got used really heavily, more than other times, and it made people start to question it. I think the other thing that made other countries start to question it was, as we keep hitting these debt ceilings and our debt's going, again, a lot of money was given out over the past couple of years. That has totally pushed us into this extra level of devaluation against these other countries that we've borrowed money from through trade and through products, and things like that. And so next month they're going to be voting on whether or not they're going to raise the debt ceiling or not. I think they're probably going to. I think they probably have to. If they don't, recession's going to come faster and harder, a lot quicker.
Yeah.
They're
definitely going to pass that. They pass it every time because, they'd rather kill us death by 1,000 paper cuts than shoot us in the head, which is, what that would be doing.
Yeah. So they're going to pass that part. But I think you're right. I think what happens is if we can't use our dollar to influence people, we've used our dollar to influence the Ukraine-Russia deal pretty heavily. But again, the amount of money that's getting spent on that starts to devalue it. So yeah, I think having military power, if we're talking like worst case scenario, becomes way more important than it was several years ago.
Yeah.
Because when you're fully in debt to other countries, it's like, how do you protect yourself if they come saying, hey, the bill is due, the bill comes due.
Yeah. Very interesting. What do you think's going on with this central bank dollar? What's your take on that? I think it's a terrible thing. And
the digital dollar that they're trying to do?
you and I'll have a phone call after this, and we say something that the regime doesn't like or whatever, and all of a sudden our bank accounts are locked, and
Yeah.
I'm concerned about that sort of stuff. But what's your real world take on this? Is this a viable thing? Do you think that we're going to see more push towards this? Do you think it will actually happen? And in Florida, they just passed some legislation against the adoption of any sort of central bank digital currency. Do you think the states are going to begin to move in that direction? What's your take on that?
It's really weird that they're doing it. It's weird that because the reality is right now, Ian, the dollar is as digital as it will ever need to be. I could send you however much money I needed to send you in the next few minutes. And really, like, there's all these different, like, the point of a digital dollar, right? Like, I can Venmo someone money instantly. I can Cash App them. I can wire money. Like, our dollar is already digital. And them changing to this, like, newer system with just a lot more tracking on it and a lot more like where everything's going, it's just kind of like unneeded. And so you're figuring like, so what is the point of something that has no real purpose? There's no practical need for it. Then it gets my conspiracy theory stuff going. It makes it think like, no, so I think that it's a bad idea. I hope that it doesn't take much flight. The only way that it'll get adopted is through like legislation. And if it gets adopted heavily through legislation, then it's going to be the idea of trying to make, Bitcoin access. Some countries have made accessing Bitcoin illegal. Some countries have made accessing. So there's a better chance of kind of those other kind of pushes. So yeah, I think it's a horrible idea. But I also think there's no practical need in it. And so it gets confusing.
Yeah.
When you keep everything in banks right now, one thing we recently saw, maybe you're going to ask about, it's like the bank defaults, and they're going to be like, we're starting to see more bank defaults and all these FDIC bailouts of it. So it's kind of like, so what's the point of our money being anywhere that it is right now? Like but it's safe until it's not. It's safe until all of a sudden it's like, again, the dollar could start to get weaponized against our own people. Weaponized is probably too strong for that, but like new taxes or something to try to pull more cash out of the system, or limitations on withdrawals or something.
I don't think it's too strong. I mean, I think we've seen some of the, non-elected federal agencies really weaponizing currency, IRS and other agencies against individual people and individual ideas. So I don't think you're too far off with that statement. I agree. There's no practical usage to it other than the desire to be able to control it. Governments hate decentralized anything, especially currency, because they can't manipulate it. They can't inflate it, because the government loves inflation, right? Because the government owes all this money to all these people in all these countries. And so, if you borrow $100 and you got to pay back $100 plus interest, so now you owe 120 or whatever, that sucks. We got to figure out how to pay for that. But if we just print $1,000 extra, right, then we can pay our 120 and still end up with 880 that we didn't have before. It's a wonderful thing to create inflation when you are a debtor. And I think that's, why these countries are making access to Bitcoin and other things like that illegal, is they don't have any control over manipulating that supply. And when they can't manipulate the supply, they don't have the ability to inflate or deflate as it suits their needs, and also people can transact without their blessing and their permission. They don't know that it's happening necessarily. They don't have to approve of it. And governments don't like that. They want to approve of everything you do or disapprove of it.
I think something you said there that most people probably don't realize, or maybe it's just worth saying again, is governments do try to create inflation. That is their goal. That's always the goal. That's how wealth gets passed from older generations to new generations, because older people are on retirement. They have a fixed income of like $3,000 a month. Like, how do they make sure that the assets they have get passed new? So they always try to create inflation. They struggle because technology brings costs of things down. My first 36-inch tube TV was like $4,000, and now I can get one for $300. So technology brings costs down, and
efficiencies bring costs down.
Efficiencies fights inflation. So the government's been trying to create lots of inflation since like 1990, and they haven't been able to. Well, now it's just gone way too strong. It's now like, now it actually got out of hand. And it's out of hand when everyone's like, wait, this is out of hand. My income has not gone up, but housing prices have gone up double. What do I do? So they want this like fine line inflation growth
And the Fed
thing.
talks about that. They have a target rate, right? Their target rate's in the twos. That's what they like.
Yeah.
But it really could be zero. And if they didn't print any more money, as productivity and production grows and population grows, technically there would be like a deflationary effect, right? There would be less money per unit of individual with more things to buy with that less money. Everything comes down. That's terrible for governments, right? Because then they're sort of unneeded and their bills come due, and it actually costs them a lot more to pay back in the future than it did when they used it, right? So it's an interesting thing to look at the system and how it is set up, and what we're seeing right now, like you so eloquently said, it's just a little out of control. It's out of the I don't feel it range, and it's in the this is hurting me and we're going to come for your jobs sort of range for the politicians, right?
Yeah. They want inflation to be as high as they can without us noticing, without us complaining, without anything crazy happening. And it's again, it's a business plan. It's a business plan for government and paying debt. They want to create inflation. Inflation is healthy. I mean, everybody, essentially, if you're getting a 10% raise a year, right, you're beating inflation, right? In theory, but everyone expects I'll make more money next year than I make this year. So yeah, it's inflation is complicated. The dollar is complicated. And my biggest worry right now is just that recession is here, recession is coming, and recession is going to be getting worse. Housing is a big focus that people keep looking at, but like office stuff is going to trickle down. People that think this doesn't affect me, it's going to trickle down. And the best thing somebody can do about it is, like you said, is find some of those spaces that are going to lose value and figure out what that solution is going to be. Like one of your entrepreneur listeners right now is going to go, I have a great idea for what that strip center should be. I have a great idea for what that set of restaurants should be, or what that mall should be. A lot of big opportunity in that space, but it's going to be a while before, like, I think 9 months from now is when we'll be feeling the worst in the recession of like, man, unemployment's up. Right now, people are still spending money too. That's like what's keeping some of the inflationary stuff up.
Yeah.
It's hard to break a habit. When everybody gets all the new money, like people started spending money like they'd never had before, right? Like, oh, cool. I like going to restaurants every weekend, or these nice ones. So you get a free check. Government says, go spend it. We do. And people like that. So now that their income has slowed down, there's no more free money. People are still spending. And I think that happens until like credit lines are kind of cut off, and it's like, okay, you've used up all your credit card stuff.
And you can see that happening, right? The per capita debt is rising.
Per capita debt is rising big time. That's why inflation is still going up, even though they've seized some of the dollar stuff. They've like slowed it down with rates. Once some of those debt rates get capped on individuals, and they just go, frankly, I don't have any money anymore. I can't make my credit card minimums. But I think that's another 9 months before we really start seeing the rest of that.
That's interesting. So one last thing before we adjourn, because this is infinitely interesting. I mean, we could sit and talk about this for hours and hours. How bad do you think it gets? What does it look like for the average person, and what should they do about it?
Yeah. I think for the average person, extra bonus money and raise increases that people thought, would normally be coming, I wouldn't be expecting those over the next 9 months. And I would be looking at like backup plans of how safe my job is and how safe my industry is. And I mean, I had to do big layoffs in one of my companies, 6 months ago, right? So I own several different businesses, but one of them got hit incredibly hard. And I had to do big layoffs in a company that I wouldn't have predicted that a year prior. And so it's just stability in general, business will be less. And so people should be saving money right now. They should be trying to go like, what if I didn't have a job for a couple months? What would our life look like? How much money would I need in the bank? Would I have that? Kind of come up with a plan so then it's less devastating. Oh, if I had to get another job, where would I be looking? For entrepreneurs and business owners, it's about creating budgets to go like, so imagine all of a sudden your income goes down 20% in your business. You or I, we're going to go look at our P&Ls and we're going to go say, okay, I need to remove one person. I need to cut this cost. I have 4 subscriptions to this. What entrepreneurs should be doing right now, today, is looking at your balance sheets and your P&Ls and making the changes today as if your income's already gone down 20%.
Proactive. Yes, we're doing the same thing. I've got
emotionally,
a meeting with one of our CFOs. Yeah.
Emotionally, it's easier after you've lost the money, because then you don't feel bad. but like really you should do it now inside your business because then you're ready for the storm. And sorry, I cut you off.
No, it was good. Yeah. So we're doing the same thing. We're going through and saying, hey, what is really needed right now? Hey, we've got the capital today, right? But what if we don't in the future, right? What if you see that downturn? What if our clientele is affected and that starts affecting us? So I think that that's really, really wise. It's no fun,
Mhm.
right? It's no fun, but it's wise. So they should start saving, looking for backup plan. If you're an entrepreneur, get into your P&L and figure out, hey, what do you need? What do you not need? Start making some of those changes now. Where do you think the biggest opportunity is in the next 9 months or a year with all of this?
Yeah, I think real estate's been my go-to, and I think there's two different strategies for real estate plays right now. You could look at places that are this was the big strategy that the hedge funds did back in '09 was they looked for like what places have had the biggest declines from the peak and like investing now because any peak that the city has hit will happen again. Usually it takes 5 to 9 years somewhere in there for it to happen again. So you find a housing market that's like, oh, we're down 30% from a year ago is now a good time to buy. If you're going to hold for 7 to 9 years, yeah, it is. I think that some markets are going to go down another 10% still, right? And so should you wait till it's down 40? Maybe, but if you're going to hold for 7 to 9 years, like now's a
It's a
pretty good
solid
time to
bet.
buy something discounted because I remember when the housing market crashed from like a 700,000 house became 250 in California. I said it'll never be 700 again. And 6 years later, it was. It had like hit peak values again. So it will happen. So real estate's great for inflationary markets where I think that inflation is still pushing hard. That's where dollars go, more than anything else. And I think that there's finding something where you think that no matter what, the price of this is going to go up. It's not in automobiles even went up, and now they've come down with things. But I think biggest opportunity is in kind of defaulted real estate stuff, and then also like getting great talent. So like if you can be a business and you can like readjust and be in growth mode, the greatest part for an entrepreneur, for a business owner right now is I remember a year ago putting an ad out for like, executive assistants and having people requesting multiple high six-figure incomes for like a job, for very simple, low level stuff, and we're not seeing that now. And so there's also a good chance that like good people are getting laid off because the highest paid people are usually the best people getting laid off.
Yeah.
So it's a great time to get better talent, to get your business ready for expansion, try to gain market share without spending money. So when the faucet turns the other way, you're ready to go like crazy.
Yeah, we're seeing that like mad right now, right? We couldn't. I mean, you got a guy wanting $120,000 to do a $40,000 job
Yep.
a year ago, and today because of the layoffs in the big tech, you can get these high level tech guys for nothing because
Yep.
they're all over the place. They're just getting, they're making 150, 200 grand at Google or at Facebook or at YouTube or wherever. And now there's tens of thousands of them looking for stuff to do. And so I think you're right. If you can be in expansion mode right now and start picking off some of that better talent and building your bench, right?
Yeah.
So that the talent pool in your business is refined and is upgraded, I think you're going to be in a great position. So Aaron, listen, this has been a lot of fun, a lot of great information. How do people connect with you? Where do they find you?
Yeah, the best way to chat. I love Instagram right now. It's where I put most of my content. It also goes on to Facebook and some other places, but it's the one I check the most the most often for like messages and things like that. My Instagram is easy. I should be the only one. It's at Aaron Amuchestegi. When you get through the AARONAMU, it'll probably like guess it the rest of the way because it's a pretty unique one. I love chatting with people on there. I love teaching people about real estate investing. I like making big predictions and like trying to help people. Like all the big moves I make, I make them live. I have the Real Estate Rockstars podcast. People can listen if they really like real estate. So I'd love to chat with any of you guys there. And maybe next time, the other big opportunity that's out there, Ian, that we should chat about at a different time, I think, is buying businesses from other people that are retiring, that are realizing like, hey, this is so much effort. I think that's a whole different opportunity.
Yeah, I've watched that sort of come to prevalence here in the last few months, and that's a movement that is starting to pick up steam with all these baby boomers they have these sort of small businesses, these medium-sized businesses, and they're just shutting them down. They don't know where to go. They don't know who to sell it to with the process. They just want to be done. They're tired. They're retiring. They want to get out. And there is an opportunity for sure right now in the roll-up space, especially, if you can get 5 or 10 guys that are all doing the same thing and aggregate it, run it on a single operating system and get your revenue up from 1 unit to 10 units, and then you can roll it up into something bigger on a PE deal or something. We're seeing a lot of that out in the market. It is definitely another topic. So guys, listen, hey, go follow Aaron on Instagram. Give him a shout out there. Aaron, always a pleasure. You are a wealth of wisdom and insight. So thank you so much for your time today. And as always, thank you guys for spending a few minutes with us, getting better together, because when we get better, things get better. Until next time.